Thank you, and thank you all for joining me to discuss the Bank of Canada's Financial System Review, which we published this morning. The purpose of the FSR is to identify and explain key vulnerabilities in the Canadian financial system. Vulnerabilities need not lead to serious problems. Some will work themselves out before bad things happen. But the lesson from history is that if left unchecked, vulnerabilities can lead to calamities, either because they amplify negative shocks by making a bad situation worse, or because they become sources of instability themselves. On analyse les vulnérabilités avec deux objectifs. Le premier est de mieux gérer les risques. En expliquant les vulnérabilités et leurs possibles conséquences négatives, on cherche à mieux informer les gens. Plus les ménages, le secteur privé, les autorités financières et publiques comprennent les vulnérabilités du système financier, plus ils peuvent les gérer et les neutraliser. Mais les risques ne peuvent pas être éliminés. Les chocs sont toujours imprévisibles. C'est donc possible qu'un gros choc ou une série de chocs frappe avant qu'on ait pu atténuer une vulnérabilité. C'est ce qui m'amène au deuxième objectif, mieux gérer les crises. Avec les plans d'urgence efficaces, on peut grandement réduire l'impact d'une catastrophe. Mieux les vulnérabilités du système financier sont comprises, mieux on peut se préparer. The analysis showcased in the FSR underpins our assessments of the priorities for strengthening risk management and crisis preparedness. For the past 14 months, a very extreme event, the COVID-19 pandemic, has affected people's health and economic well-being unlike anything we've seen before. A year ago, we used the FSR to provide analysis of the early impacts of the pandemic on the Canadian financial system. The current FSR looks at how things evolved and highlights short and medium-term issues of concern. And I'd like to take a few minutes before answering your questions to touch on three themes in our FSR: our collective resilience, the need for continued vigilance, and the imperative to think ahead and act now on key medium-term vulnerabilities. The Canadian financial system went into this crisis in a solid position and has proved to be resilient. This reflects sound risk management across a range of financial sector participants, combined with Canada's strong regulatory and supervisory framework. Unprecedented policy support from governments and the Bank of Canada has played a crucial role. Together, these factors have allowed the financial system not only to weather the huge shock, but also to act as a shock absorber for the broader economy. When financial markets seized up in the early weeks of the crisis, the bank provided overwhelming liquidity to the system. This was essential to keep credit flowing, and it worked. Markets recovered quickly and have been functioning normally for some time now. That's why in recent months we have wound down our extraordinary market-making and liquidity facilities. Still, there are plenty of reasons for us to all remain vigilant. Globally, an improving economic outlook and low interest rates have led to strong investor risk appetite. This has raised the prices of a range of assets and narrowed credit spreads to near back to pre-pandemic levels. A rapid change in market sentiment, perhaps due to a setback in efforts to end the pandemic or a stalled economic recovery, could cause a sharp repricing of risk and a tightening in global financial conditions. And this could spill back into Canada and could interact with existing vulnerabilities. Wider credit spreads could particularly affect Canadian companies that rely on high-yield debt markets. The biggest domestic vulnerabilities are those linked to imbalances in the housing market and high household indebtedness. These are not new, but they have intensified because of the very unusual circumstances caused by the pandemic. Les plus grandes vulnérabilités au pays sont celles liées au déséquilibre sur le marché du logement et à l'endettement élevé des ménages. Elles ne sont pas nouvelles, mais elles se sont intensifiées en raison de la pandémie. With so many Canadians working and studying at home, people want more space. Consumer preference combined with low interest rates has boosted demand for single-family homes, particularly in suburbs. Housing supply has not been able to keep up with this surge in demand, and this has pushed prices for single-family homes sharply higher in several markets. Our analysis suggests that in some markets, price expectations have become extrapolative, meaning people may be rushing to buy partly because they expect prices to keep rising. This behavior can exaggerate near-term house price increases relative to fundamental demand. During the pandemic, many households have added to savings and have paid down consumer debt. And at the same time, though, some households have taken on significantly more mortgage debt. The increased issuance of mortgages with high loan-to-income ratios is of most concern. At an individual level, Canadians need to be prudent in taking on new debt. It's important to understand that the recent rapid increases in home prices are not normal. Even without a shock, some of the factors that cause prices to rise fast could reverse later, and that could leave some households with less equity in their homes. Au niveau individuel, les Canadiens doivent être prudents quand ils empruntent. Il faut comprendre que la hausse récente et rapide du prix des maisons n'est pas normale. Même sans choc, certains des facteurs qui ont fait monter rapidement les prix pourraient s'inverser, et ce qui fera baisser l'avoir propre foncier de certains ménages. And interest rates are unusually low. Borrowers and lenders both have roles in ensuring that households can still afford to service their debt at higher rates. Counting on ever higher house prices to build home equity that can be used to refinance mortgages in the future is a bad idea. In this regard, the proposal by the Office of the Superintendent of Financial Institutions to introduce a fixed floor to the minimum qualifying rate for uninsured mortgages is welcome. As well, measures in the federal budget should help increase the supply of housing. More generally, achieving a better balance between demand and supply in the housing market will be important for reducing these housing-related vulnerabilities. In the FSR, we also discuss a number of ongoing issues that we need to take seriously now to protect our financial system and economy in the future. First among these are climate-related vulnerabilities. The potential impact of climate risks is generally underappreciated, and they are not well priced. That means the transition to a low-carbon economy could leave some investors and financial institutions exposed to large losses in the future. In this FSR, we use a new approach to map how severe weather events and financial vulnerabilities could interact. We find that in some parts of the country, particularly British Columbia and Ontario, households that are highly leveraged are also more exposed to severe weather events. The bank, together with OSFI and the financial sector, is also working to address financial system implications of different scenarios for transition to a low-carbon economy. We're learning a lot from this work, and we will publish a report on this later this year. A second ongoing vulnerability is fixed income market liquidity. While financial markets are currently functioning well, the extreme market stresses that occurred when the pandemic struck highlighted the vulnerability of the financial system to sudden spikes in the demand for liquidity. Over the past decade, the potential demand from asset managers for market liquidity in periods of stress has outpaced the capacity of banks to provide it. And we are working both at both the domestic level and with our international partners to better understand this structural liquidity vulnerability and how best to improve the resilience of core funding markets. Finally, the digital transformation of the economy and the interconnected nature of the financial system globally and in Canada increases the risk of a cyber attack. The recent ransomware attack on a top U.S. pipeline is a timely illustration. The FSR discusses a number of cybersecurity initiatives the bank is leading. And with that, I would be happy to answer your questions. Sur ce, je serai heureux de répondre à vos questions.
Thank you very much, Governor. Now we will go to questions. We're going to do one question and a quick follow-up per reporter in this first round, and I'll ask you to state your name and affiliation when called on. I'll just want to remind people that to mute their line if they're not asking a question, you can do so by pressing *6 and unmute by pressing *6 again. Avant de poser une question, veuillez vous identifier. Libre à vous de poser vos questions dans la langue officielle de votre choix. Pour mettre votre ligne en mode discrétion, appuyez sur *6. Pour l'enlever, faites *6 encore une fois. So our first questions will come from Kim McCrail of the Wall Street Journal, followed by Shelley Hagan of Bloomberg, and then Jordan Gowling from CTV. So Kim, first question and follow-up to you, please.
Thanks. Kim McCrail from the Wall Street Journal. The report that was published today shows that high loan-to-income ratio mortgages make up a greater proportion of new mortgages than they did during the 2016-2017 boom. And higher house prices are more widespread regionally compared with that period. So I'm wondering if you can explain that, in 2016, 2017, we were hearing a lot of alarm bells about housing markets. To what extent are we in a similar situation, and if not, what's different this time?
Well, thanks, Kim. Let me say a few things about what we're seeing, and then back up a little bit and provide some assessment of why it's happening. So, as you highlighted, our particular concern is that we are seeing the increase in mortgage debt is particularly concentrated in mortgages with high loan-to-income ratios, and the measure we focus on, which is a fairly standard one, is the mortgages that are more than 4.5 times, the loan is more than 4.5 times the income of the borrower. And as you suggested, those have risen. They're running at about 22% of mortgages now. Pre-crisis, it was in the teens. Sort of 13, 14%, and as you mentioned, back in 17, 18, or 16, 17, peaked at sort of the high teens. So it is somewhat above, and that is a worry. We do worry that households could be stretching, and the evidence we're seeing of extrapolative expectations in some markets in Canada. Provides additional concern. When we look at some other measures relative to where we were 16, 17, there is some pickup in investor demand in housing, but it is not as pronounced as it was in 16, 17. We're seeing some evidence of people turning over houses quickly, or sometimes called flippers. Again, there's some evidence that that's increased, but again, not nearly as much as 2016, 17. So coming back to what's going on here, to a large extent, as you indicated, this is very broad-based in Canada. In fact, you're seeing this in most countries around the world, and it really comes down to the fact that with so many, with lockdowns, containment measures in Canada and around the world, everybody's spending a lot more time at home. In Canada, more than 5 million Canadians are working at home. Children are studying at home. Recreation is at home. People want more space. And they're willing to move, and with more flexible work arrangements, likely to stay to some degree. They're willing to move to the suburbs and to other towns because they expect they won't have to commute as much to work. What our concern is that with this big surge in demand, supply has not been able to keep up, and that has led to a rapid rise in prices. And some people may be thinking that the kind of price increases we've seen recently will continue. That would be a mistake. And in that regard, the measures taken by or proposed by OSFI to introduce a minimum floor qualifying rate in the B20 guidelines, I think that will be helpful. Interest rates are very low. That means there's more potential for them to go up. We've seen the B20 guidelines work in the past, and I think putting some dynamism in them to reflect that we're in this unusual circumstance with very low interest rates will be helpful.
Thanks. And to what extent are you worried that the extraordinary forward guidance you've given in terms of how long interest rates are expected to remain low will continue to fuel this?
So, look, housing is an important part of the economy, and we've built into the outlook that we published a month ago is a trajectory for housing. We do expect to see strength, but we also expect to see this market coming better into balance as we move forward. With respect to monetary policy, we need to look at the needs of the whole economy. The whole economy clearly needs our support. Important parts of the economy remain very weak. Far too many Canadians are unemployed. That is putting downward pressure on inflation. And the economy needs our support to get back to sustainably at our inflation target. I think using other macroprudential measures to protect Canadians and manage this vulnerability, I think is helpful. And as I said, we welcome the proposal by OSFI. There are also some measures in the budget that should be helpful that will add supply, and by putting a vacancy tax on homes owned by foreigners, that will sort of reduce any speculative demand that could come from foreign investors.
Thank you, Kim. We'll now go to Shelley Hagan from Bloomberg, please.
Hi, Governor Macklem. I wanted to follow up on Kim's comments on the housing market. And a lot of people are blaming the Bank of Canada for these housing excesses because of low interest rates. So what would be your response to them?
Well, my response is, first of all, you need to keep in mind that what we're seeing in the housing market to an important degree reflects the very unique circumstances of this pandemic. As I outlined, this is largely driven by fundamental demand. Canadians, particularly, we're all spending a lot more time at home. Canadians want more space. And the other thing that's changed is that rather than being very concentrated in downtown cores, it's more in suburbs, more in smaller communities outside major cities. And supply has simply not been able to pivot quickly enough to keep up with that demand. And what you're seeing is rapid increases in prices. And yes, interest rates are low. That is making borrowing more affordable. And that is part of what is supporting this market. I think where we worry, though, is that when people start to extrapolate from this recent experience, and that may lead them to overstretch. And if Canadians overstretch, at some point in the future, the risk is that their access to credit will be more limited. They will have to reduce their consumption a lot more than they'd want to in order to pay their mortgages. That's not going to be good for them. It also could create sort of an extra sort of macro cycle, and that's really an important focus of this report, bringing in these macro financial conditions in our assessment of the risks and vulnerabilities.
And has the bank calibrated its policy to reflect these concerns on household debt and housing market vulnerabilities? And if the bank does, would the policy outlook be looser if these vulnerabilities didn't exist?
Sorry, can you just repeat the question for me there? I didn't quite catch the last part of it.
I was wondering if the bank's policy is calibrated to reflect these concerns in the housing market. And would your policy outlook be looser if you didn't have these housing market vulnerabilities to worry about?
So, as I indicated, the outlook for housing is built into our overall outlook. We're certainly spending a lot of time analyzing housing markets. We put out, several weeks ago, we put out some analysis. We provided considerable analysis in this report. What is the sort of the main purpose of this analysis? Well, the main purpose of this analysis is really to make sure that borrowers, lenders in the financial system, non-financial businesses, financial regulatory authorities across Canada, governments across Canada, are fully informed in these risks and vulnerabilities to help them take more informed decisions to manage these risks better. We do factor in housing into our monetary policy decisions, but we do have to look at the whole economy. Housing is an important part, but as I indicated, there are important parts of the economy that remain very weak, and the economy needs our support. We are very focused on our mandate of getting inflation back to target, and our judgment is that that support is needed and will be needed for some time.
Okay, thank you, Shelley. We're going to go now to Jordan Gowling from CTV, followed by Julie Gordon of Reuters and Mark Rendell from the Globe and Mail. So, Jordan, your first question, please.
Good morning, Governor Macklem. My first question is, the bank recently announced it would be cutting its government bond purchases from $4 to $3 billion a week last month. Do you envision the bank reducing that further anytime soon?
Well, I'm really here today to talk about our financial stability report. We've got our next monetary policy decision in early June, and at that time we'll give you we'll certainly we'll take a decision and we'll provide you an update on our outlook. Well, on our sort of assessment of incoming data. Certainly, we'll have a new outlook in July. With respect to our quantitative easing, I mean, what we indicated a month ago at the time of our decision is that any further adjustments will reflect our assessment of the strength and durability of the recovery.
And what tools does the Bank of Canada have to slow down the hot housing market if you won't raise interest rates? I know you mentioned that the OSFI has approved a new minimum qualifying rate, and you mentioned the vacancy tax, but what else can the Bank of Canada do to slow down this market?
Well, as I indicated, the main purpose of this report is really to put out our analysis of the vulnerabilities in the housing market, in household indebtedness, as well as other vulnerabilities, cyber, climate, liquidity. In some areas, we have more direct responsibilities. Our liquidity facilities being an obvious example. Our oversight of systemic payment systems being another example. And our analysis of the risk and vulnerabilities informs how we exercise our responsibilities. But an important purpose, and perhaps the most important purpose of this report really, is to inform everybody in the system. That includes Canadians, includes non-financial businesses, it includes the full range of financial sector participants, as well as other financial regulatory authorities in Canada and governments. And the Bank of Canada also participates in various forums with other levels of government. We participate, for example, in the Senior Advisory Committee chaired by the Deputy Minister of Finance that has the key federal players. We also participate in the Financial Financial Institution Supervisory Committee. Got to remember what these acronyms stand for, which is chaired by the superintendent and also includes the members of the federal financial regulatory authorities. I actually chair something called Heads of Agencies, which includes the Department of Finance and the large securities regulators in Canada. And we bring this analysis and we share this analysis with all the players. And in doing so, that allows each of us to take decisions that are well informed by evidence-based analysis and research.
Okay, thank you, Jordan. We're going to go now to Julie Gordon from Reuters, please.
Thank you. Hi, Governor, and thanks for taking our questions. I guess I just want to ask, at what point does the risk to the economy of a housing bubble exceed the bank's concerns about other areas of the economy, like labor market scarring, for example?
Yeah. It's a hard question to put a number on. Let me underline that we're acutely aware that this housing market is really making it difficult for some Canadians to get into the housing market. And I can tell you, if I need any reminder, each week I review my correspondence that I receive from Canadians, and there are a lot of letters, many from young households with small children. They're looking for that first home. They're having real difficulty breaking into the housing market, and we do worry about that. And we want to see Canadians achieve their goals. We want to make sure that they're not overstretching and creating a situation that could be difficult for them and could have macro consequences. The other thing we also have to worry about all the other parts of the economy. There's still 500,000 jobs that have been lost since the beginning of the pandemic that the economy has not got back. There's probably roughly about another 200,000 people that, students that have entered the job market over this more year of pandemic. Mothers that are coming back from maternity leave, other people that are coming into the labor market. We have to worry about them too. And the key to achieving our inflation target, our mandated objective, is making sure that overall in the economy, there is a balance between demand and supply. That is what will sustainably get inflation back on target. And right now, there's still a lot of excess supply in the economy.
And I mean, just to follow up on that, from the other side, I guess, is it time, if you're sitting here and putting all this information out for us today on what's going on in the housing market, it's obviously a concern for you. Is it time for government to step up and intervene a bit more than they have already? And if not, what conditions would get us to that point?
Well, as I said, government, first of all, let me say a few things. This was a vulnerability before we went into this pandemic. And what we're seeing now as it is intensifying. But, over the past number of years, a number of measures were taken. The B20 guidelines being a good example of a measure that was taken. It has clearly had some effect. It has strengthened underwriting standards. That is reducing the vulnerability to the financial system. The banking system has high levels of capital. That's reducing the vulnerability to the system. So measures have been taken. We're in a very unique situation right now. And with respect particularly to the B20 guidelines, what I'd highlight is that when that guideline was brought in, the qualifying rate in the stress test was 5.5%, 6%. With interest rates now so low, that qualifying rate has come back. And what I think is makes a lot of sense in the OSFI proposals by putting this minimum floor at 5.25. What that is doing is it's reminding everybody, borrowers and lenders, that interest rates are very low. And at some point, eventually, they're going to go back up. And we want to make sure that households, when are taking out a mortgage now, they fully understand, and the lenders fully understand, and everybody's assured that Canadians can afford that mortgage when interest rates do eventually go up. So there have been a number of measures taken. There are some new measures being taken, and I think our hope is that in putting out this analysis, that will help everybody in the system take more informed decisions going forward.
Thank you, Julie. We're going to go now to Mark Rendell from the Globe and Mail, followed by Jordan Press of CP, and then Greg Bunnell from Bloomberg Business News. So, Mark.
Thanks. Hi, Governor. Can you hear me?
Yes, I hear you well, Mark.
Great. Thanks. First, quick question about just yesterday's inflation numbers. I know that's not the topic exactly of today's address, but was there anything? They obviously came in higher than you expected at 3.4%, and there seems to be strong month-to-month growth and not just the kind of transitory year-over-year base effects. Anything in yesterday's numbers that has changed your outlook for inflation or timing around monetary policy?
Well, yes, I do want to focus more on the financial system report, but yes, I'm happy to respond on inflation. Mark, we have been saying for some time that we expected inflation would go up to around 3%. And that's because a year ago, inflation was very low. In fact, a year ago, inflation was slightly negative. And what that means is that the base price for many of the goods and services in the CPI a year ago was very low. And we measure inflation as the 12-month rate of change. So when you start from a very low number, you can get a large increase. We expect that will be temporary. We call these base year effects. In fact, if you look at StatsCan's publication yesterday on the CPI, they did a good job of explaining these base year effects. And we also put something up on our website to update our sort of explanation of base year effects. So anybody wanting a little more explanation, have a look there. But I think the important point is that these base year effects are temporary. They will dissipate going forward. And as they dissipate, the underlying downward pressure on inflation coming from the fact that we have a lot of excess supply in this economy will pull inflation back down closer to target. With respect to our outlook, we put out our outlook in our April monetary policy report, and this trajectory for inflation that I've just explained, it's in our projection. We will get some more data before our next decision. I guess the most important piece will be the national accounts. That'll certainly give us, what we can see. The data we do have for the first quarter certainly suggests it's going to be a very strong quarter. The national accounts will give us a better sense of how much strength will be sort of handed off from the first quarter to the second quarter. But overall, the data we have received in the month or so since our April MPR, both on inflation and on output, is broadly in line with the projection that we laid out a month ago. As I said, we will be getting more data. We will be updating our views, and we'll certainly lay that all out for you and our next monetary policy decision date in early June.
Great. Follow up on the actual report today. You talk about liquidity in fixed income markets and the challenges that we saw last March. I'm wondering, what did you learn about the fixed income market last March that you didn't necessarily see before when bond markets started seizing up? And on top of that, you mentioned the banks looking at expanding who may have access to facilities in moments of crisis. Can you tell me a little bit more about what that might look like or what that means?
Yeah. So look, we went into this pandemic incredibly suddenly, a little over a year ago. This is a hopefully once in 100-year pandemic. And in that circumstance, there was huge amounts of uncertainty. Markets froze, and the Bank of Canada came in very quickly in scale with a whole series of liquidity and what we call market maker of last resort programs to restart markets. And fortunately, it worked, and we've now been able to unwind those programs. I think there's two ways to look at it. You can say, okay, well, this was just a once in 100-year thing, and it's not going to happen again, so don't worry about it. Well, I think one of the things, what we saw, though, yes, this was a very extreme shock. But what we did see is that, and what this experience highlighted, is that the asset management industry has grown relative to the banking industry. It's bigger. The other thing is, in the asset management industry, is particularly in this low interest rate environment that we've been in now for more than a decade, there is more search for yield. They are taking on more alternative assets, real estate, infrastructure, for example. Those tend to be less liquid. In some cases, they're also using leverage to boost returns. Again, that increases their liquidity demand. And I think what we saw is in this severe episode a little over a year ago, that the liquidity demands coming from the asset management industry were simply the banking industry, which is sort of the dealer banks, which are the market makers. They simply could not keep up with the demand for liquidity. They had their own clients, their own corporate clients drawing their lines. And as a result, the system froze very suddenly, and we had to come in scale. So going forward, our sentiment is that there has been a gradual structural shift with the asset management industry requiring more liquidity, and that may outstrip the ability of the banks to provide it in very stressed situations. So what does that mean in practice? It means two things. There will be some analysis of what sort of liquidity requirements should there be in the asset management industry. And then the other part, which is particularly for us to look at, is what are the implications for our emergency liquidity facilities? The last thing I'll say is this is not unique to Canada. This same scenario, this same set of events played out in major economies around the world. And there is an international effort coordinated through the Financial Stability Board to look at the vulnerabilities in what's called the non-bank financial sector, or non-bank financial institutions, and particularly what are the implications for liquidity and how to manage that, what expectations should be on the demanders of liquidity, and what are the implications for central banks and the design of their liquidity facilities.
Okay, thank you for that. I've got 4 names left on my list, and I'm hopeful that we can get through them all. So let's go quickly now to Jordan Press of the Canadian Press.
Good morning, Governor Macklem. I'm wondering, with this report and everything you've said about housing, you have a lot of messages for a lot of different actors in the housing market. So I'm wondering, who do you hope hears your message the most? Is it the home buyers, the homeowners, the lenders? And what is the key takeaway you want them to have?
Jordan, look, let me give you, I think, the key takeaways from this report. I mean, I think the first key takeaway is that the financial system has actually been very resilient to the COVID shock. And that reflects sound risk management in the system. It also reflects the response of the government in providing extraordinary fiscal supports and our own response with the exceptional liquidity we provided. That should be reassuring to Canadians. But the second message is that we do need to be vigilant. And some of the vulnerabilities that we had before the crisis have come back. And top of the list is vulnerabilities related to housing and household indebtedness. And they have intensified. And I think the message to Canadians is don't extrapolate from the current rapid increases we've seen in prices. Don't expect that those will continue indefinitely. Don't expect that you can refinance, pull equity out and refinance your mortgage in the future on the basis that prices are going to continue to go up like we've seen. So yes, I think Canadians should be prudent in the debts that they take on. Borrowers should really be making sure that their they're lending in a way, they're lending to support borrowers who will be able to afford the debt that they take on. And I think for other financial authorities, various levels of government, the analysis we put out, I think, will be helpful in helping them assess the vulnerabilities and assess, assess what sort of measures they might want to be considering if more ultimately needs to be done.
And just as my follow-up on another part of the report, when it comes to climate change, I'm wondering if, given the vulnerabilities that you see there, and given the need to have more financing towards a low-carbon economy, as the report points out, do you see a requirement or a need, as suggested by one of your counterparts in Europe, for the Bank of Canada and other central banks to use their purchases and balance sheet as a way to more actively drive financing towards a low-carbon economy?
Mm-hmm. Well, let me just say two things on that. First of all, I think our primary role here at the Bank of Canada is really to help the financial system do what it needs to do to manage these climate risks. And I'd particularly highlight the scenario analysis pilot that we've embarked on jointly with the Office of the Superintendent of Financial Institutions and six financial institutions. And the idea there is to work with the financial system to develop these scenarios and a methodology to apply these climate scenarios to their balance sheet and assess what is the potential for losses and to understand those now so that the financial system can manage those. And the better risk is priced, that should accelerate the flow to more sustainable investments. So that's an important thing we can do. A second thing that we're beginning to work on, the government indicated in their debt strategy the intention to issue a green bond. We're the agent of the government in this regard, and I think a green bond, a federal green bond, if designed well, could become a benchmark that will be helpful to price these more broadly in Canada. Certainly, we expect to see, given everything we're seeing in this market, we expect to see strong investor demand. Once, depending on where our QE program is, I could imagine that could be included in our own purchases if we were doing QE when that is fully implemented. More broadly, we certainly are reviewing our activities. As I indicated, we have wound down our corporate bond purchase program, so that is less of an issue. And when we implemented it, it was very much an emergency program. And in the context of an emergency program, you really want to support the economy you have. It's not the time to cut people off.
We'll go to Greg Bunnell now, followed by Greg Quinn.
Yes, Governor. I know you're anxious to talk about housing. We barely talked about it all during this, so I want to ask you a housing question. More specifically, it's pretty clear today from your statement, right? You said you've got to balance out the economy with the interest in the housing market. Your tack seems to be warn Canadians home prices don't go up forever. Don't knock yourself out with debt. Sort of that's what the Bank of Canada can do. But if I had to sum up what I think I've been hearing from the federal government lately, is that they won't even stomach any policy that would threaten a pullback in prices, even a minor one. Do you feel you're fighting an uphill battle here when Canadians take that away from the other side of the aisle? They say, well, sure, the Liberals don't seem to want to do anything that would tame this housing market, and you just have a warning stick, basically.
I actually think we have a distribution of responsibilities in Canada across the system, and I think if you look over the past number of years, I think what you've seen is that different players are taking actions. We've seen a number of actions taken by different governments, by the Office of the Superintendent of Financial Institution, by provincial regulatory bodies. And it does take some time. I think you've got to recognize we're in a very unique situation here. This sudden surge in demand is very much linked to the pandemic. As we all get back to more normal activities, we may see this diminish to some extent on its own. I think from our perspective, it's important to put out the analysis, all the analysis we have, and help everybody take more informed decisions.
All right, thank you, Governor. No follow-up.
Thank you, Greg. We'll go to Greg Quinn from Market News.
Good morning. I saw the report mentioned a survey of investors who cited uncertainty around the pace of fiscal or monetary stimulus being withdrawn. Given that the government and the Bank of Canada have said that the stimulus is going to be in place until the economy has recovered, I wondered if you can elaborate on what investors were talking about. Was it uncertainty that the stimulus would be removed too soon, or that it would be removed too quickly, or just an overall bit of confusion there?
Well, I noticed that too. I guess from monetary policy perspective, I think Canadians can be assured that we are looking at the whole economy. We are very much guided by our inflation control mandate, and we will be providing ongoing assessments, and we will be taking decisions that help the economy get back to full capacity and inflation back to target. I think what you're hearing from market participants is that I've used this word a lot. This is a very unique situation, and as the economy reopens, the uniqueness of the situation isn't going to go away immediately. There are going to be some bottlenecks. There are going to be some shifts in demand between different activities as this economy reopens. During these lockdowns, obviously any services that require high contact, we can't consume those. So that's been very low. You've seen households buy a lot more goods. That's creating certain supply issues in certain goods sectors, and we're talking about housing. Clearly, the boom we've seen in housing across North America is showing up in lumber prices in a big way. As we get back, as containment restrictions are lifted and we get back to more normal activities, you're going to see some shifts in those pressures. And I think what we're hearing from people is there's a lot of uncertainty in just exactly how that's going to play out. And so that was my main takeaway from that. But certainly anytime you read in a survey, participants are worried about what the Bank of Canada is going to do. That is something we read very carefully.
Secondly, I'd like to go back to housing again. Governors past and present have talked about the Bank of Canada being the last line of defense on housing imbalances. I wondered how close is the Bank of Canada to actually becoming the last line? Is the puck here with the four checkers or with Carey Price at this point?
I guess it is playoff time in Canada, our favorite time of year. Look, as I've said repeatedly, we're very focused on our inflation mandate. Clearly, financial vulnerabilities are something we need to keep an eye on. It's something we need to factor in to our decisions. But our monetary policy is very guided by our inflation objective. Monetary policy is a broad instrument and we need to think about the whole economy. And that's what we're doing. As I've said several times, it is really important that Canadians, borrowers, other levels of government, everybody in the system has a really good understanding of the risks and vulnerabilities in housing. And by understanding it, that should help everybody manage it. It will take a collective effort.
Thanks for that, Greg. We are just about out of time, but I'm going to call on Dave Parkinson of the Globe and Mail for one final question, please. Dave.
Sorry, just unmuting. I didn't think I'd get a chance. Thanks, Governor. Just wanted to touch on the inflation question from another perspective. It was certainly one of the issues brought up in the report in terms of market vulnerability, is that that there was a possibility of a shift in inflation expectations being a meaningful vulnerability to the markets. And certainly, we've heard a lot of talk, given anecdotal evidence of price increases, given what we've seen from the actual CPI numbers, both here and in the U.S. There have been concerns that central banks on both sides of the border are not prepared to move quickly on this, and that perhaps people are suggesting that in fact there has been a shift in perception on inflation, and that itself is a meaningful risk. So I guess I'd just like to know how concerned you are that inflation expectations are starting to become unhinged from the 2% target.
Well, Dave, as I indicated, we put out our outlook for inflation. We expected it to come up to around 3. It has done that. And we'll be assessing the data going forward, but so far the data both on the real economy and on inflation is coming out broadly in line with the outlook we provided in April. I will remind you, though, that in that report we highlighted a number of risks. There are always risks around an outlook, and one of those risks was that the increases of inflation that we expected to see become more persistent than we expected. And certainly, how might that happen? Well, particularly as the economy reopens rapidly, we could see more. We've already seen some supply chain problems. We could see more supply chain problems. Some parts of the labor market are very weak. Other parts of the labor market are actually quite strong. So you could get a very differentiated labor market with some wage pressures in parts of the labor market. So it is, there is a risk that this run up in inflation proves to be more persistent than we've expected. At the same time, I would underline there's also some downside risks on our projection. One we particularly highlighted on the downside is, an important element of our projection is that we see some broadening from consumption to exports, and we get a strong rebound in exports. The Canadian dollar is now 2 to 3 cents above where it was when we put out our projection, and that, and particularly if the Canadian dollar gets stronger, that will weigh particularly on our exporters, manufacturing exporters. It'll reduce their competitiveness, and that creates a downside risk to our projection. So there are risks on both sides. When we put out this projection a month ago, we indicated they were roughly balanced, and as I indicated, data's come out broadly in line with that. I think we certainly are looking at inflation closely, and one of the real important features of our framework is that we put out our inflation forecast. We put it out there for everyone to see. So if inflation comes in persistently higher than what we forecast, you're going to see it, everybody's going to see it. We will certainly be looking at why that is happening. If it's happening because we think there's a series of very temporary factors, I expect we wouldn't react. But if if there is a material and we view this as a real step up in our whole inflation forecast, that is something that we would definitely take into consideration in our monetary policy decisions. We certainly have the tools and we have the commitment to achieve our inflation mandate. And I think Canadians can be confident that we will do that. And just finally, with respect to inflation expectations, to this point, they've remained very well anchored. We have a long tradition of 30 years now of achieving our 2% inflation target on average, and those inflation expectations remain well anchored. And certainly, if we were to see them start to become, to use your word, unhinged, that would be something that we would take very seriously.
Thank you very much, Governor. We've gone on a bit long, so I appreciate your indulgence there. That will conclude today's press conference. Thank you, Governor Macklem. Thank you all for joining us.
Thank you.